Good evening, and welcome back to SleepWise. Tonight, we drift into one of the strangest and quietest stories of the modern world, the story of money and the careful machinery that keeps it standing. It is a story of paper and promises, of printing presses and central banks, of trust that builds slowly and sometimes thins without anyone quite noticing. That may sound like a subject for textbooks and serious offices, but tonight we will approach it softly. No charts, no jargon, no need to remember every figure. We will simply move slowly through the idea and let it unfold at the pace of breath. Money is one of those things so familiar that we almost stop seeing it. A coin in a pocket, a note tucked into a wallet, a number that appears on a screen when a wage arrives. It moves through our days quietly, doing its work, asking nothing of us but our continued belief in it. And there, in that small word belief, lies one of the deepest mysteries of ordinary life. For a piece of paper has no intrinsic worth. A linen note printed with intricate patterns is, in itself, only that, linen and ink. A coin is only metal. A digital balance is only an entry in a ledger maintained by someone else. And yet these small things command the movement of food, of housing, of medicine, of labor. They do this not because of what they are, but because of what we have agreed they mean. This agreement is older than nations. Long before central banks, long before printed money, people exchanged grain for tools, salt for cloth, shells for cattle. Somewhere along the way, certain objects became trusted enough to serve as middle steps. A merchant in one market would accept a piece of silver because she knew another merchant in another market would also accept it. The thing itself mattered less than the shared confidence that surrounded it. We have inherited this strange arrangement and refined it across centuries. The money in our pockets today is more abstract than the silver of ancient markets, and yet it works for the same reason. We believe it will work. The people we hand it to believe it will work. The shops that receive it believe their suppliers will too. A long, invisible chain of confidence runs beneath every ordinary purchase, and most days we never feel it. Tonight, we will trace the quiet story of that belief, how it has held, how it has sometimes broken, and how, in our own century, it has come to rest on institutions most of us rarely think about. Central banks, with their careful committees and their power to create new money with a keystroke. There is no need to follow every step closely. Just let the shape of the story arrive. If these slow journeys help you rest, you can follow SleepWise and share it with someone who might enjoy falling asleep while learning something new. And now, with the night around us and the world's quiet machinery of money still gently turning, let us begin. To understand why this machinery matters, we begin not in a modern central bank, but in a city that learned, almost a century ago, what happens when money loses its meaning entirely. The city is Berlin. The year is 1923. Germany has emerged from the First World War defeated, indebted, and bound by the Treaty of Versailles to pay reparations of a magnitude few economies could absorb. To finance the war years, the government had quietly suspended the gold backing of its currency in 1914 and run the printing presses harder than peacetime had ever required. By the early 1920s, the mark was already drifting downward. Then, in January 1923, French and Belgian troops occupied the Ruhr industrial region after Germany fell behind on payments. The German government responded by paying striking Ruhr workers with freshly printed money. The drift became a fall. At the center of the operation sat the Reichsbank, led by its president, Rudolf Havenstein. Under his direction, more than 130 printing firms and nearly 1,800 presses worked around the clock to produce banknotes in ever larger denominations. The numbers on the notes climbed past anything an ordinary person could comprehend. Bills of 100 million marks, 1 billion, 100 billion, each issue trying to catch a value that was already moving away from it. The texture of daily life began to bend. A loaf of bread that had cost about 250 marks in January 1923 cost roughly 200 billion marks by November. Wages were paid twice a day and spent immediately, because by evening the morning's pay would buy less. Photographs from the period show children using bundled banknotes as building blocks, and householders feeding marks into stoves because the paper was cheaper than firewood. Pensioners who had saved across a lifetime found that their savings now bought a single newspaper or nothing at all. It was not chaos in the cinematic sense. People still went to work, still tried to feed their families, still wrote letters and rode trams. But the quiet contract beneath ordinary life had cracked. The word thousand stopped meaning much. Then million, then billion. Numbers grew so large that they emptied themselves of feeling. The end came not from one decisive act, but from a careful rebuilding of belief. In November 1923, Germany introduced a new currency called the Rentenmark, backed nominally by mortgaged German land. A new official, Hjalmar Schacht, was appointed currency commissioner. The new notes were issued in strictly limited quantity, and remarkably, almost overnight, prices began to stabilize. The crisis ended not because the underlying problems had been solved, but because people chose tentatively to believe in the new arrangement. The Weimar experience left a long shadow over German thinking about money. It is one of the reasons the modern Bundesbank, and later the European Central Bank, treat price stability with such seriousness. Decades later, on a different continent, another currency would walk a similar path. Zimbabwe, in the late 1990s, had been one of the more productive economies in southern Africa, with a strong agricultural sector and a relatively stable currency. The Zimbabwean dollar, introduced at independence in 1980, had once traded at near parity with the U.S. dollar. But around the year 2000, several pressures began to compound. A government land reform program disrupted commercial farming, agricultural output fell sharply, foreign investment retreated, and tax revenues weakened. The state's expenses did not. To cover the widening gap, the Reserve Bank of Zimbabwe began to issue increasing amounts of new currency. Gideon Gono, who became governor in 2003, presided over this period. As output fell and money expanded, prices climbed. Inflation moved from high to alarming to almost incomprehensible. By 2007 and into 2008, the numbers entered a territory economists could no longer measure with precision, because by the time figures were gathered, prices had already moved again. Independent estimates suggest that monthly inflation in Zimbabwe peaked around 79.6 billion% in November 2008. To make sense of such a figure, imagine prices roughly doubling every 24 hours. The denominations on the banknotes climbed in step. The Reserve Bank issued million-dollar notes, then billion-dollar notes. In January 2009, it issued a $100 trillion note. The figure on the paper was so large it almost looked like a typographical error. In practice, a single note bought less than a bus fare across Harare. The texture of daily life shifted as it had in Berlin. Shop shelves emptied because importers could not predict prices. People queued for bread at dawn. Wages were spent immediately, often in the same hour they were received. Where the Weimar story had its wheelbarrows, the Zimbabwean story had its persistent shopkeepers, updating prices several times a day, and households turning to barter and to U.S. dollars passed hand to hand. In April 2009, the Zimbabwean dollar was effectively abandoned for everyday use. The country moved to a basket of foreign currencies, primarily the U.S. dollar and the South African rand. The official currency was not loudly buried. It simply faded out of use, replaced by quieter substitutes. Like the Weimar episode, the Zimbabwean experience was not caused by ordinary central bank policy. It emerged from collapsing productive capacity, lost institutional credibility, and a state that found the printing press easier than the alternatives. These are extreme cases, the far end of a long spectrum, but they are useful to hold in mind tonight. Beneath every banknote in every pocket lies an institution, a promise, and a great deal of quiet trust. In our own century, that institution has a name we hear often without thinking about it carefully: the central bank. For most of human history, the people who made money were rulers. Kings stamped their faces onto coins. Empires set the weight of silver in their denarii. The right to issue currency was bound to the right to govern, and the value of money to the trust placed in the sovereign behind it. That arrangement still echoes faintly in our own time, but the institution that issues money today is no longer a king. It is a central bank, a small, careful, technical organization usually housed in a serious building run by economists and lawyers, rather than monarchs. And although central banks are now woven into every advanced economy, they are surprisingly recent. The Federal Reserve, the central bank of the United States, was founded in December 1913. That may sound like a long time ago, but it is younger than the automobile, younger than the airplane, younger than electricity in most American homes at the time. Before the Federal Reserve, The United States had passed through long stretches of banking instability, with periodic panics in which depositors lost confidence in private banks and rushed to withdraw their savings. The Fed was created to provide a steady hand during such moments. The Bank of England is far older, founded in 1694, originally to help finance government debt. It evolved across centuries into the model that many later central banks would borrow from. The Bank of Japan was founded in 1882. The German Bundesbank emerged in its modern form in 1957, deeply shaped by the Weimar memory. The European Central Bank, the youngest of the major institutions, was established in 1998 to manage the new euro. These institutions do many quiet things. They set short-term interest rates, the cost of borrowing money in their respective economies. They serve as lenders of last resort to commercial banks during moments of stress. They oversee the soundness of the banking system, and crucially, they have the power to create new money electronically with the keystrokes of authorized officials. This last power is the one that matters most for tonight's story. It is worth pausing on that idea because it can sound stranger than it is. When a central bank creates money, it does not typically run physical printing presses, except for the small portion that circulates as paper and coin. Most modern money exists as digital entries in the accounts commercial banks hold at the central bank. When the central bank chooses to expand the money supply, it credits these accounts. The new money is real in every sense that matters. It can be lent out, spent, and used to purchase assets. But it began as a decision, recorded in a ledger. That power is enormous, and central bankers have long known it. Through most of the 20th century, they used it with great caution. The story of how that caution slowly loosened is one of the quieter dramas of modern economic history. And it is where our journey turns next. To understand what central banks do today, it helps to know what they used to be constrained by. For most of the 20th century, the major currencies of the world were tethered to something physical. Most often, that something was gold. The idea was simple in principle. A currency was worth a certain amount of gold, and that promise stood behind every banknote. If you held a dollar or a pound, you held a small claim on the gold reserves of the issuing country. This arrangement, called the gold standard, dominated international finance through the 19th century and the early decades of the 20th. The discipline it imposed was real. A country could not simply print more money than the gold in its vaults would justify, because doing so would invite a run on those reserves. If too many holders demanded to convert their notes into metal, the arrangement could break. Central banks under the gold standard were less the masters of money than its keepers. The system did not survive the First World War. Most combatant nations suspended gold convertibility in 1914 to finance the war by printing money and borrowing. Attempts to restore the old system after the war were uneven, and the Great Depression of the 1930s shattered what remained of it. By the end of the 1930s, the world's monetary order was in pieces. Then, In July 1944, with the Second World War still underway, delegates from 44 nations gathered at a mountain resort in Bretton Woods, New Hampshire. Over 3 weeks, they negotiated a new international monetary system. The agreement tied the major currencies to the U.S. dollar at fixed exchange rates and tied the dollar to gold at $35 per ounce. The dollar became the anchor. Gold remained somewhere behind it. For nearly 3 decades, this arrangement held. Trade expanded. Currencies were predictable. The painful instabilities of the 1920s and 1930s seemed to have been laid to rest. But the system carried a quiet tension. The United States issued the dollars the rest of the world needed for trade, and as it did so, more dollars circulated abroad than there was gold in American vaults to redeem them. By the late 1960s, foreign governments and central banks were aware of this gap. Some, notably France, began converting their dollar reserves into gold, drawing down American holdings. Pressure mounted. On August 15, 1971, President Richard Nixon appeared on American television and announced that the United States would no longer convert dollars into gold at the fixed rate. The link between the dollar and gold, already strained, was simply cut. It is hard to overstate how quietly enormous this moment was. From that evening forward, every major currency in the world was, in technical terms, fiat. Its value rested not on metal in a vault, but on the credibility of the institution that issued it. The central bank had become the sole guardian of the value of money. The decade that followed the end of the gold link did not go smoothly. Freed from the discipline of metal, but inheriting a world of rising oil prices, labor tensions, and growing government spending, the major economies of the 1970s drifted into a strange new condition. Prices rose, growth slowed, unemployment climbed. Economists, who had long assumed that inflation and unemployment moved in opposite directions, found themselves facing both at once. They gave it a name that captured the discomfort of the period: stagflation. In the United States, consumer price inflation, which had hovered around 1 or 2% for most of the post-war period, climbed past 5% in the early 1970s, then past 10% by 1974, then settled uneasily before climbing again toward the end of the decade. The 1973 oil embargo, when Arab oil-producing nations cut exports in response to Western support for Israel during the Yom Kippur War, quadrupled the price of crude almost overnight. A second oil shock followed in 1979, after the Iranian Revolution. The cost of nearly everything that moved on wheels or warmed a home rose with it. Through these years, the Federal Reserve responded cautiously, raising interest rates at times, but reluctant to push the economy into recession. The result was that inflation became embedded in expectations. Workers demanded higher wages because they expected higher prices. Businesses raised prices because they expected higher wages. The spiral fed itself. In August 1979, President Jimmy Carter appointed Paul Volcker as chairman of the Federal Reserve. Volcker was a towering man, both literally and in reputation, known for his disciplined mind and willingness to make unpopular decisions. He took the position with a clear conviction. Inflation had to be broken, and the only tool that would break it was a sharp and sustained rise in interest rates. He moved quickly. By 1980 and into 1981, the Federal Reserve pushed its benchmark interest rate above 19%. Borrowing costs across the economy followed. Mortgages, business loans, and consumer credit became punishingly expensive. The result was the deepest recession the United States had experienced since the 1930s. Unemployment rose past 10%. Farmers, builders, and small business owners suffered visibly. Volcker received death threats. Members of Congress called for his removal, but the strategy worked. By the mid-1980s, inflation had fallen to around 4% and continued downward. The painful medicine had broken the spiral, and the experience left a generation of central bankers with a deep conviction. Price stability, once lost, was extraordinarily costly to restore. Far better to protect it carefully, year after year, than to let it slip and face another Volcker recession. That conviction became the foundation of modern central banking. It would shape the next decades in ways no one quite anticipated. When Paul Volcker stepped down in August 1987, his successor inherited an institution that had recovered its credibility. Inflation was tamed, the economy was growing, and the Federal Reserve was widely regarded as one of the most respected institutions in American public life. The new chairman was Alan Greenspan, a quietly spoken economist with a long career in private consulting and a reputation for careful, technocratic thinking. He would hold the position for more than 18 years. Greenspan's first test came almost immediately. On October 19, 1987, a date that would be remembered as Black Monday, the Dow Jones Industrial Average fell by 22% in a single trading day. Markets around the world followed. There was real fear of a cascading collapse, a repeat of 1929 and the new electronic age. The Federal Reserve, only weeks into Greenspan's tenure, responded with unusual speed. It issued a brief statement affirming its readiness to provide liquidity to the financial system, and it cut short-term interest rates. The panic subsided. Within months, markets had stabilized. The lesson was noted carefully, not just by economists, but by investors. The Federal Reserve, it seemed, would not stand passively while markets fell. It would act. And the experience of seeing it act decisively and successfully planted a quiet expectation that would grow over the years. The pattern repeated. In 1998, a large hedge fund called Long-Term Capital Management, run partly by Nobel-winning economists, ran into severe trouble after the Russian government defaulted on its debt. The fund's positions were so large and so interconnected with the major banks that its collapse threatened the broader system. The Federal Reserve coordinated a rescue and cut interest rates to calm the markets. Again, the strategy worked. Then came the dot-com crash of 2000 and 2001. Technology stocks, which had soared through the late 1990s on optimism about the new internet economy, fell sharply when many of those companies failed to generate profits. The broader stock market followed. The Federal Reserve, under Greenspan, cut interest rates aggressively from around 6.5% in 2000 to 1% by 2003. By this point, a phrase had entered the language of financial markets: the Greenspan put. The term came from the world of options trading, where a put option protects a holder against losses. The idea was that the Federal Reserve, under Greenspan, would reliably cut rates and ease conditions whenever markets fell significantly. Investors began to factor that expectation into their decisions. It was not a formal policy. Greenspan himself never described his approach in those terms. But the pattern had become recognizable. Each crisis was met with lower rates and more liquidity. Each time, the strategy seemed to work, and each time, the implicit promise to markets grew a little stronger. Something subtle was happening through these years, though it was difficult to see while it was happening. With each successive crisis, the response of the world's major central banks grew a little larger, the rates cut a little deeper, the easing held in place a little longer. What had begun as emergency intervention slowly became expected practice. In 1987, the Federal Reserve had cut rates and provided liquidity for a few weeks before withdrawing the support. In 1998, the easing lasted longer and ran wider. After the dot-com crash, the Fed kept its benchmark rate at 1% through 2003 and 2004, the lowest level in nearly half a century. Each step seemed reasonable in isolation. Each step was also a step further from the cautious posture of the Volcker years. Outside the United States, the pattern was visible too. The European Central Bank, founded in 1998 to manage the new euro, was younger and more conservative by design, but it also cut rates significantly during the dot-com aftermath. The Bank of England followed similar contours. The Bank of Japan, dealing with its own long slowdown following the collapse of its real estate and stock market bubbles in the early 1990s, had already cut its policy rate effectively to zero by 1999. It was the first major central bank to discover what happens when rates run out of room to fall. A new orthodoxy was forming. Central banks could and should smooth the business cycle. They could lean against downturns with lower rates and looser conditions. They could prevent recessions from deepening into something worse. The painful boom and bust patterns of earlier eras, this thinking went, were not inevitable. They could be managed. There was a great deal of confidence in this view by the mid-2000s. Economists spoke of the Great Moderation, a period of unusually stable growth and low inflation across the advanced economies. Central bankers were widely praised. Greenspan was called the maestro. Beneath that confidence, however, certain quieter dynamics were building. Low interest rates encouraged borrowing. They pushed investors to seek higher returns in riskier places. They lifted asset prices, particularly in housing. The American housing market climbed steadily through the early 2000s, supported by easy credit and by financial innovations that allowed mortgages to be bundled, repackaged, and sold worldwide. For a time, this all seemed to be working. Homeowners felt wealthier. Banks reported strong profits. Mortgage lenders extended credit to borrowers who would have been turned away in earlier decades. But each layer of confidence rested on the layer beneath it. And beneath all of them quietly lay an assumption that house prices would continue to rise, that the central bank would continue to manage things smoothly, and that the system was stronger than it had ever been. None of those assumptions, however, would survive the events of 2007 and 2008. Let us slow our breath for a moment before stepping into what came next. The years we have traveled through were ones of confidence, of careful management, of an institution growing steadily more central to the world's economy. The crisis that arrived in 2008 did not come from nowhere. It came from the slow accumulation of small risks beneath that confidence, and from the discovery of how connected the system had become. The first cracks appeared in 2007. American homeowners with subprime mortgages, loans extended to borrowers with weaker credit, began to fall behind on their payments. House prices, which had risen for years, began to fall. The bundled mortgage securities sold around the world, often rated as safe by major credit agencies, began to lose value. Banks that held these securities, or that had insured them, faced unexpected losses. Through 2007 and into 2008, the strain intensified. The investment bank Bear Stearns, a name with more than 80 years of history, collapsed in March 2008 and was sold in a rushed deal to J.P. Morgan Chase with Federal Reserve support. The mortgage giants Fannie Mae and Freddie Mac were placed into conservatorship in September. The system trembled. Then, on September 15, 2008, the investment bank Lehman Brothers filed for bankruptcy. It was one of the largest bankruptcies in history. Unlike Bear Stearns months earlier, Lehman was allowed to fail. The decision was debated then and is still debated now. What was undeniable was the effect. Within days, credit markets around the world froze. Banks stopped lending to one another. Money market funds, treated as nearly as safe as cash, faced runs. The American International Group, an insurance giant, required an emergency loan from the Federal Reserve to avoid collapse. The financial architecture that quietly underpinned global trade was suddenly visible, and it was shaking. At the center of the response stood Ben Bernanke, who had succeeded Greenspan as chairman of the Federal Reserve in February 2006. Bernanke was a scholar of the Great Depression, a quietly spoken academic from Princeton who had spent his career studying exactly the kind of crisis now unfolding around him. His professional life had prepared him to recognize what was happening and to act quickly. The Federal Reserve cut interest rates aggressively. By December 2008, the benchmark rate had reached a range of 0 to 0.25%, effectively as low as conventional policy could go. Economists called this the zero lower bound. Beyond it, the traditional tool of monetary policy could no longer be used. This was the moment when the old toolbox ran out. The Federal Reserve had cut rates as far as they could go. The crisis continued. Unemployment was rising. Banks were still fragile. Something else would have to be tried. And what came next would change the practice of central banking in America and across the developed world. What the Federal Reserve did next had been discussed in academic papers and tried by the Bank of Japan, but never at this scale by the American Central Bank. It was called quantitative easing. The name itself is gentle and technical, but the underlying action was significant. With interest rates at zero, the Federal Reserve began creating new money and using it to purchase assets directly from the financial system. The mechanics, set out simply, work like this. The Federal Reserve creates new electronic money in its own accounts. It uses that money to buy government bonds and other securities from banks and financial institutions. The sellers receive freshly created money in their accounts at the Federal Reserve, and the Federal Reserve adds the purchased securities to its own balance sheet. The amount of money in the financial system grows. The supply of those assets in private hands shrinks. The hope was that this would lower long-term interest rates, encourage lending, support asset prices, and nurse the economy back to health. The first round, later called QE1, began in November of 2008. The Federal Reserve committed to purchasing up to $600 billion in mortgage-backed securities. Over the following months, this expanded to include longer-term government bonds. The numbers grew with each phase. QE2 was announced in November of 2010, with another $600 billion in Treasury purchases. QE3 began in September of 2012, without a fixed end date. The Federal Reserve would simply continue buying assets each month until the labor market improved. The effect on the Federal Reserve's own balance sheet was striking. Before the crisis, the Fed had held roughly $900 billion in assets, accumulated over decades of ordinary central banking. By the end of 2014, that figure had grown to over $4 trillion. The institution had expanded its balance sheet by more than 4 times what had taken nearly a century to build. This was not the printing of physical banknotes. No new currency was being trucked from a mint to flood the streets. The expansion happened almost entirely as digital entries in the accounts banks held at the Federal Reserve. But it was money creation in the truest sense. New financial assets had been called into existence by an act of central bank authority. There was a great deal of debate at the time about whether this would work and whether it was wise. Some economists warned that it would lead to runaway inflation. Others argued that without it, the recession would have deepened into something far worse, perhaps another Great Depression. The Federal Reserve, under Bernanke, leaned on the historical lesson he had studied for decades. The failure of central banks to act in the early 1930s, he believed, had turned a recession into catastrophe. He would not repeat that mistake. What began at the Federal Reserve did not stay at the Federal Reserve. Across the Atlantic and across the Pacific, other major central banks faced their own versions of the same problem. Their economies were stalling. Their interest rates were approaching zero. One by one, they reached for the new tools. The European Central Bank, headquartered in Frankfurt, faced a particularly delicate situation. The Eurozone contained 19 countries with shared currency but separate fiscal policies. After the 2008 crisis, a follow-on sovereign debt crisis erupted, with Greece, Ireland, Portugal, Spain, and Italy facing severe pressure on their government bonds. Investors began to question whether the Eurozone itself could hold together. Some countries were shut out of borrowing markets. In July of 2012, the president of the European Central Bank, Mario Draghi, gave a short speech in London that has since become famous. He said the ECB would do, in his words, whatever it takes to preserve the euro. The phrase was carefully chosen. Markets understood immediately that the central bank was prepared to use its balance sheet on a scale not previously contemplated. Bond yields in stressed countries began to fall as soon as Draghi finished speaking. The ECB later followed through with its own large-scale asset purchase programs, beginning in 2015. By the late 2010s, its balance sheet had grown several times over. The Eurozone had become accustomed to extraordinary central bank support. In Japan, the experience was, in some ways, the deepest. The Bank of Japan had been wrestling with low growth and low inflation since the early 1990s, when its asset price bubble had collapsed and left behind decades of slow recovery. Rates there had been at or near zero for years before the rest of the world joined them. In April of 2013, under its newly appointed governor Haruhiko Kuroda, the Bank of Japan launched what it called quantitative and qualitative monetary easing. The central bank committed to doubling the country's monetary base within 2 years, purchasing government bonds at an aggressive pace. Even the Bank of England, with its long history of monetary discipline, joined the new approach. Its first quantitative easing program began in March of 2009, and successive rounds followed. By the mid-2010s, the major central banks of the world were running similar experiments in parallel. The combined size of their balance sheets had grown into the tens of trillions of dollars. Interest rates across the developed world were unusually low. In some places, including parts of Europe and Japan, short-term rates fell below zero, into the strange territory of negative interest rates. Depositors were being charged to hold money in certain accounts. The world had entered an era of monetary policy unlike anything in its recorded history. Here is where the story takes an unexpected turn, and where it is worth slowing down for a moment to consider what happened. Common intuition and a great deal of older economic theory would have predicted one obvious outcome from all this monetary expansion. If central banks were creating trillions of dollars of new money, prices in the broader economy ought to rise. Goods should cost more. Wages should climb. Inflation, the textbooks suggested, would arrive in proportion to the printing. For more than a decade after 2008, it did not. Across the United States, the Eurozone, Japan, and the United Kingdom, consumer price inflation remained stubbornly low through the 2010s. Central banks had set an inflation target of around 2%, considered the level of mild, healthy price growth. For most of the decade, they undershot it. Some quarters saw inflation drift below 1%. Japan flirted with outright deflation, the slow falling of prices that economists generally consider more dangerous than mild inflation. This was a puzzle economists discussed at length. The amount of new money created by central banks dwarfed any peacetime monetary expansion in modern history. By traditional measures, it ought to have produced visible inflation, perhaps even severe inflation. It did not. Some who had predicted runaway inflation in the early 2010s were left, year after year, wondering when their forecasts would come true. There were partial explanations. The global financial system was deleveraging, with banks and households repaying old debts rather than taking on new ones, which absorbed some of the new liquidity. Globalization continued to pull manufactured goods prices downward as production moved to lower-cost regions. Technological progress kept many prices flat or falling. Wages in advanced economies grew slowly, restrained by globalization and by quieter changes in labor markets. But there was another effect that ran through every advanced economy, even if it was less often discussed alongside consumer prices. Asset prices rose substantially. Stock markets reached new highs through the 2010s. Government bonds rallied as their yields fell. House prices in major cities, particularly London, New York, Sydney, and Toronto, climbed to levels that strained the budgets of ordinary working families. The wealth of those who owned assets grew. The position of those who did not stayed the same. This produced a strange decade. Economists could honestly report that inflation, measured through a basket of consumer goods, remained calm. Anyone trying to buy a home, however, or save toward retirement, or invest in the major asset classes, was living in a world where prices had risen substantially. There were, in effect, two stories about prices unfolding at the same time. Where the new money had gone was the question economists would spend years trying to answer. To understand why a decade of unprecedented money creation produced so little consumer price inflation, it helps to look more closely at how newly created central bank money actually moves through an economy. When a central bank purchases bonds from a commercial bank, the seller receives an electronic credit in its reserve account at the central bank. That reserve money is not the same as the money you spend in a shop. It sits inside the banking system used by banks to settle transactions with one another and to meet regulatory requirements. For the new money to reach the broader economy, commercial banks would need to lend it out and borrowers would need to spend it. Only then would it touch goods, services, wages, and consumer prices. In the years after 2008, that final step was less complete than expected. Banks, recovering from the crisis and facing stricter new regulations, were cautious about lending. Households and businesses, scarred by the recession, were cautious about borrowing. Much of the new central bank money, therefore, stayed inside the financial system, held as bank reserves or used to bid up the prices of financial assets. There is a useful, if simplified, way to picture this. Imagine the financial system as an upper floor of a great house, with the broader economy on the floor below. Quantitative easing flooded water onto the upper floor. The water raised the level there substantially. Some of it eventually trickled down through the pipes into the floor below, but much of it remained where it had been poured. This helps explain the strange pattern of the 2010s. Asset prices, which respond directly to the abundance of money in the financial system, rose sharply. Consumer prices, which respond more to wages and to supply and demand in the wider economy, rose only mildly. The link between money creation and inflation, once taught as nearly automatic, turned out to be more conditional than the older textbooks had suggested. It also helps explain why hyperinflation did not arrive. Weimar Germany and Zimbabwe had not simply printed money. They had printed money into economies whose productive capacity had collapsed and whose institutional credibility was broken. New money chased a shrinking supply of goods and prices ran wild. The post-crisis advanced economies, by contrast, had functioning industries, working supply chains, deep institutional trust, and significant slack in their labor markets. New money entered a system that could absorb it. But this lesson came with a quieter warning. The conditions that allowed monetary expansion to coexist with stable consumer prices were not permanent. They depended on the broader economy continuing to function smoothly and on people continuing to trust the institutions that managed money. Both of those assumptions would be tested in the events of the early 2020s. The test arrived sooner than anyone expected. In the early months of 2020, a new virus moved across the world, and within weeks, the global economy was undergoing something it had never experienced quite this way before. Governments closed borders, workplaces shuttered, restaurants, theaters, airports, and shops fell quiet. Demand for some things collapsed almost overnight, while demand for others, like home delivery and digital services, suddenly surged. For central banks, the speed of the shock left little time for measured deliberation. Within days of the worst of the early panic, the Federal Reserve cut interest rates back to near zero, where they had not been since the previous crisis. It announced new lending facilities, and it returned almost immediately to quantitative easing on a scale that surprised even those who had grown used to the tool. The numbers tell part of the story. In the spring of that year, the Federal Reserve expanded its balance sheet by roughly $3 trillion in a matter of months. By comparison, the entire first round of quantitative easing a decade earlier had been about $600 billion. What had been an experimental measure was now being deployed almost casually at speeds and sizes never previously contemplated. Other major central banks moved in the same direction at the same pace. The European Central Bank launched a new pandemic emergency purchase program. The Bank of England restarted its asset purchases. The Bank of Japan expanded its already enormous program. The combined response of the world's major central banks across that year exceeded the total monetary expansion of the previous decade. This was not central bank action alone. Governments around the world also acted with unusual speed. sending direct payments to households, supporting payrolls, and propping up businesses that could not operate. The combined fiscal and monetary response was unprecedented in peacetime. There were good reasons for the urgency. Without rapid action, the sudden collapse in economic activity could have cascaded into widespread bankruptcies, mass unemployment, and a financial crisis layered on top of the public health crisis. The painful memory of the previous decade was still fresh. Policymakers were determined not to let that happen again. For a time, the response appeared to work. Financial markets, which had fallen sharply in the early weeks of the shock, recovered quickly. Stock indexes returned to previous highs and then climbed beyond them. Household savings, supported by direct payments and reduced spending opportunities, grew during the early months of the pandemic. But beneath the calm financial surface, conditions were shifting in ways that would soon make themselves visible. The system that had absorbed monetary expansion so quietly during the 2010s was no longer the same system it had been. Then, slowly at first, and then unmistakably, something began to change. Through the second year of the pandemic, as economies reopened and people returned to spending, prices started to rise. At first, the increases were dismissed as temporary, the result of supply chain hiccups, shipping costs, the shortage of a few specific goods. Used cars climbed, lumber climbed, then groceries, then rents, then services. By the middle of the following year, the pattern was undeniable. Consumer price inflation in the United States crossed levels not seen in 4 decades, reaching a peak above 9% in the summer. The Eurozone followed, with inflation pushed further by an energy crisis as Russia's invasion of Ukraine disrupted gas supplies. The United Kingdom climbed past 10%. Even Japan, which had spent decades trying to coax inflation back to its modest 2% target, began to see prices rise. Several forces were at work, and economists are still debating how to weigh them. Supply chains, designed for the careful efficiency of previous decades, had been disrupted in ways that took years to mend. Workers in many sectors had not returned to the labor market in the same numbers as before, leaving wages to climb in services and hospitality. Energy prices spiked. Shipping costs multiplied. The pile of household savings accumulated during the pandemic now poured into spending on goods that could not be supplied fast enough. But there was also the simpler explanation, the one some had been warning about for years. An enormous amount of new money had been created. Government stimulus had moved it directly into households. Consumer demand had surged. Productive capacity had not kept pace. The conditions that had quietly absorbed monetary expansion during the previous decade were no longer holding the new money inside the financial system. This time, the money had reached the broader economy, and the broader economy was beginning to rise. For ordinary people, the experience was vivid in a way inflation statistics rarely managed to convey. Grocery bills climbed visibly each month. Rents rose by amounts that left some tenants unable to renew their leases. Heating a home through a European winter became a serious financial decision. Wages also rose, but often more slowly than prices, leaving many families slightly worse off in real terms. There was nothing approaching the extreme cases we visited earlier in the night. The Weimar wheelbarrows and the Zimbabwean trillion-dollar notes belonged to a different category, a place where institutional trust has collapsed, and the printing press is the only remaining tool. The advanced economies of the early 2020s remained far from that territory. But for the first time in a generation, the abstract idea of inflation had become a daily reality across much of the developed world. And central banks faced a question they had not faced in decades. For nearly 15 years, central bankers had been engaged primarily in supporting fragile economies, lowering rates, expanding balance sheets, and providing reassurance to nervous markets. The instinctive direction of policy had been ease and more ease. Now suddenly, the direction had to reverse. The Federal Reserve, under its chair, Jerome Powell, began the turn in early spring. For a few months, officials hesitated, hoping the surge in prices might prove transitory. By the time it became clear that inflation was settling in rather than passing through, the central bank had to move quickly. Interest rates, held near zero for 2 full years, began to climb. The pace was the fastest in 4 decades. Within about 18 months, the benchmark rate rose from near zero to above 5%. The European Central Bank followed, raising rates for the first time in more than a decade and continuing to raise them through successive meetings. The Bank of England moved in parallel. Even the Bank of Japan, the most reluctant of the major central banks, eventually began to step away from its long experiment in negative rates. Around the world, the cost of borrowing rose. Mortgages became more expensive. Business loans tightened. The cheap money of the previous decade became once again costly money. The mood inside central banks shifted along with the policy. Speeches began to invoke the memory of Volcker. Officials emphasized that they would do what was necessary, even at the cost of slowing their economies, to bring inflation back toward target. Credibility, the quiet asset central banks had spent decades building, was once again at stake. The memory of the 1970s, of inflation embedded in expectations and spirals, fed by hesitation, was a memory they all carried. For households and businesses, the reversal was felt as a different kind of pressure. House prices in some major cities, which had been carried higher by years of low rates, began to soften. Mortgage payments for those on variable rates climbed sharply. Small businesses that had taken on debt during the cheap money years found their interest costs rising. The financial markets, accustomed to gentle and steady accommodation, experienced periods of unusual stress. A handful of regional banks in the United States failed in the spring of 2023, partly because their long-dated bond holdings had lost value as rates rose. Yet, gradually, the strategy began to bite. Inflation in the United States came down from its peak toward something closer to 3%. The Eurozone and the United Kingdom followed similar paths, though more slowly. By the middle of the decade, central bankers were beginning to cautiously cut rates again, no longer fighting an emergency, but trying to navigate a slower, more delicate adjustment. The Volcker memory had not faded. It had, quietly, done its work again. Let us take a quiet moment now to look back across the journey we have taken and ask a question that has been gathering beneath the surface of the story all along. Why, across more than 3 decades, have central banks leaned more and more heavily on monetary easing? Why has each crisis met a larger response than the one before? Why have the tools, once reserved for moments of true emergency, become familiar instruments deployed almost reflexively when economies stumble? There is no single answer, but there are several quieter forces that have shaped the pattern. The first is the genuine fear of repeating the 1930s. The Great Depression cast a long shadow over 20th century economic thought. The failure of central banks to act decisively in those years, the bank runs, the deflation, the mass unemployment, the descent into political chaos that followed, became the cautionary tale every modern central banker carries inside them. When a crisis arrives, the instinct is to act quickly and on a scale large enough to make sure history does not repeat. The second is the difficulty of fiscal action in modern democracies. In an earlier age, governments might have responded to recessions by spending public money directly through infrastructure programs or direct hiring. But political polarization, concerns about public debt, and the slower pace of legislatures have made fiscal responses harder to assemble, especially quickly. Central banks, by contrast, can act within hours. Monetary policy has filled a space that fiscal policy might have occupied. The third is the simple mathematics of low rates. Once interest rates approach zero, the traditional tool of rate cuts runs out of room. To do more, central banks must reach for less conventional instruments, like quantitative easing or new lending programs. Each crisis that begins with rates already low tends to require a larger and more creative response than the one before, because the conventional move is already exhausted. The fourth is harder to name, but no less real. Each rescue, by softening one painful adjustment, tends to leave the system slightly more leveraged, slightly more dependent on cheap money, slightly more fragile in the face of the next shock. When the next shock arrives, the response must be larger because the system has grown larger and more sensitive to the conditions the previous rescue helped create. The cycle is not vicious exactly, but it does grow. None of this is the product of any single decision or any single person's failure. It is the slow accumulation of reasonable choices made under pressure, each one defensible in its moment, each one quietly raising the cost of the next. This is the world we live in, a world held steady by a careful institution, doing important work with imperfect tools, in a system that has grown stranger and more dependent on its judgments with each passing decade. It is worth returning briefly to the 2 stories we visited at the beginning of our journey: the Weimar wheelbarrows, the Zimbabwean trillion-dollar notes. These are the images that come most easily to mind when people speak of money losing its value, and they shape the way many of us instinctively think about printing money. If you create enough of it, the intuition runs prices will eventually explode. But the story we have walked through tonight suggests a more careful picture. Hyperinflation, the kind that turns a loaf of bread into a billion-mark transaction, is not the natural endpoint of monetary expansion. It is a specific and rare outcome that requires several conditions to come together at once. The first condition is the collapse of productive capacity. In Weimar Germany, the Ruhr occupation had paralyzed the country's industrial heartland, and the wider economy was already weakened by the war and by reparations. In Zimbabwe, the agricultural sector that had once fed the country had been disrupted, and the wider economy was contracting sharply. New money cannot drive prices to extreme levels on its own. It needs a shortage of goods to chase. When the economy can still produce, new money is absorbed by expanding output. When it cannot, the same money piles onto a shrinking pile of bread, fuel, and basic necessities. The second condition is the loss of institutional credibility. In both Weimar and Zimbabwe, the central bank was not seen as an independent guardian of money. It was seen accurately as an instrument of a struggling government, trying to finance its commitments through the printing press. Once that perception sets in, no quantity of newly issued currency can hold its value, because the public no longer believes anyone is in charge of restraining it. The third condition is the absence of alternatives. In a modern advanced economy, people who lose faith in their currency can shift their savings into other assets. They can hold dollars, euros, gold, or property. But the institutions and laws underpinning the currency itself remain stable. In Weimar and Zimbabwe, the choices were starker, and the entire monetary system was under strain. Modern advanced economies have not been close to these conditions, even during the most aggressive periods of monetary expansion. Their industries function. Their supply chains, though sometimes strained, still operate. Their central banks remain widely trusted. Their citizens still keep most of their savings in their domestic currency. The institutional foundations are intact. This does not mean the foundations are eternal, only that they have not yet been seriously threatened. The painful lesson of the Weimar and Zimbabwean stories is not that printing money inevitably leads to ruin. It is that the conditions for genuine monetary collapse are specific, and that institutions, once broken, are extraordinarily costly to rebuild. If you spend long enough thinking about money, you eventually arrive at a strange realization. The thing itself is almost nothing. A banknote is paper and ink. A coin is metal. A digital balance is an entry in a database. And yet these almost nothing things organize the lives of billions of people, govern who eats and who does not, who travels and who stays, who is housed and who is not. The whole great machinery of modern life rests on something we have agreed to believe in together. This is what gives money its peculiar character. It is not quite a physical thing and not quite an idea. It is a social contract, made and remade every day by everyone who accepts it, holds it, spends it, and saves it. The contract works because almost everyone participates in it almost all the time. When the contract weakens, the whole arrangement begins to tremble. When it breaks, the wheelbarrows appear. The history we have traveled tonight reveals this character from many angles. The gold standard was an attempt to bind money to something tangible in the hope that physical metal could anchor belief. Bretton Woods carried that hope forward in modified form. The end of dollar convertibility in 1971 cut the last formal tether, and yet money continued to function because the trust that had once rested in metal now rested in institutions. The Volcker years showed that this institutional trust, once damaged by inflation, could be rebuilt only at great cost. The decade of quiet quantitative easing showed that even unprecedented monetary expansion could coexist with stable prices, so long as the trust held. There is a long human history of improvising money when official currencies fail. In prisoner of war camps during the Second World War, cigarettes became currency, traded for food, services, and small comforts. In post-war Germany, before the new currency was introduced, American cigarettes again served as a medium of exchange. In modern crises across Africa and Latin America, mobile phone airtime minutes have been traded as money, passed between strangers as carefully as banknotes. The instinct to create a shared medium of exchange seems to be very deep in us. When the official channels fail, we improvise new ones. What this suggests is that money is, at root, less about paper or metal or digital ledgers than about a particular kind of human cooperation. We agree to accept these tokens because we trust that others will too. The institution behind the currency simply formalizes that trust, gives it rules, and tries to protect it from the pressures that might erode it. To understand modern central banking is to understand that the institution is not, in the end, managing paper or numbers. It is managing belief. And belief, once well established, is one of the most durable things in human life. When it falters, however, it can falter quickly. And now the night has grown deeper, and the story can slow. We began with the strangeness of money itself. Paper, metal, digital entries held in pockets and accounts and wallets, doing their quiet work across billions of lives. We traveled through the wheelbarrows of Berlin, the trillion-dollar notes of Harare, and arrived at the careful institutions of our own century, with their committees and balance sheets and the keystrokes that bring new money into being. We watched central banks lean further into the printing press with each crisis, and saw how their interventions slowly grew larger, more frequent, and more essential. We watched, too, how the system absorbed an extraordinary expansion of money for more than a decade before quietly beginning to feel its weight. Through all of it, the deeper truth has stayed the same. Money is a shared agreement, held together by institutions and by trust. It works because we believe it works, and because the people around us believe the same. The central bank is the institution that watches over that belief, doing its difficult work in quiet rooms, often unnoticed, sometimes criticized, occasionally celebrated. It is not perfect. The tools it carries are imperfect. The world it manages is more complicated than its models can fully capture. But it is what stands between ordinary life and the kind of crisis we visited in the early hours of this journey. Perhaps that is the feeling to keep tonight. Not the dates, not the technical names, not the precise figures, but the mood of it. The sense that the steady coin in your pocket, the steady price on the menu, the steady number in your account is the product of a long chain of human effort and human trust. The chain runs from ancient marketplaces through royal mints, from the gold standard through Bretton Woods, from the Volcker recession through the quiet decade of low rates, and all the way to the careful committees meeting today in Washington, Frankfurt, and Tokyo. Most of the time, the chain holds. Now and then, in particular places and times, it breaks, and people pay a terrible price for the breaking. The world we live in tonight is not Weimar. It is not Zimbabwe. Its institutions remain trusted. Its currencies remain accepted. Its central banks remain at their posts, doing their quiet work. The challenges of the coming decades will be real. The temptation to lean on monetary expansion in the next crisis will be real. The questions of how much money is too much and which conditions might one day shift the answer will continue to occupy serious minds. But none of that needs solving tonight. You do not need to predict the next crisis or trace the next reversal. You only need to rest, knowing that beneath the calm of the night, vast institutions hum on, balancing risks and stabilizing prices, keeping the quiet machinery of money in motion while you sleep. The world slows, and so do we. Good night.